Hey everyone, it's Mike Bonn with Hard Money Mike. Today we're going to go over numbers, simple calculations. What is a point? How do you calculate monthly interest? Loan to ARV, loan to value. Simple things that you'll come across as you're talking to lenders. I want to make sure you understand not only what it is, but how to calculate it. So first of all, you're going to hear lenders talk about there's a point on this loan. There's 2 points on this loan. What does that mean? We get this question a lot. So what is a point? Why are lenders talking about points, and how do I calculate it? So a point, when a mortgage originator talks about a point, it's a percentage of the loan. It's their fee, it's their charge. So you'll see anywhere between 1 and 3 points on a loan. This means that they're charging somewhere between 1% and 3% of the loan amount as an origination fee. And you're going to need to know this just because it's going to come out of your pocket. It's going to add to your cost, but you're also going to need this money for closing. If you're doing a refinance, you're going to take it out or you have to bring it in. But on a purchase, you're going to have down payments, you're going to have fees. This is one of the fees that's probably going to come out of your pocket. So you need to know how much it is, how to calculate it. Let's look at an example. So grab a piece of paper, pen. Let's say your loan amount is $200,000. So this is your loan. And let's, for example, say your lender is going to charge you 1.5 or 1.5 points. So they're going to charge you 1.5 points. They're going to go like, our fee is 1.5 points. So what do you do? How do you calculate that? We're going to take our $200,000. We're going to take a calculator, phone, calculator, whatever, and we're going to put this information into our calculator because that's just the easiest way to do it. We're going to start with our loan amount. We have $200,000. We're going to put that into our calculator and we're going to times it by 1.5 points. But what does that look like when you're putting it into your calculator? It is 0.015. So we're going to type in 0.015. And we're going to find out when we hit equal that the 1.5 points that they're charging on a $200,000 loan is going to cost you $3,000. That's the origination that they're going to charge you. That's the origination you're going to have to pay at closing, probably out of your pocket, especially if it's a purchase. So you're going to have to understand points, how to calculate them. Remember, 1% is 0.01, 3% is 0.03. You need to calculate it to figure out how much is coming out of your pocket, especially on a purchase. That's going to be added to your down payment, the amount that you're going to have to bring to the table. So that's what a point is. Now let's look at how do you calculate simple interest and what does that mean for a monthly payment? So monthly payment, how do you calculate that? So your lender tells you they're charging you 10%. When they say 10%, they're not charging you 10% if you have the loan out for 2 months or 3 months. The 10% is an annual rate. So you need to calculate what that means monthly. So if they're telling you how you have a 10% rate, we're going to jump into our calculator again and show you an example of what that means on a monthly payment. In our example, we're going to use, once again, $200,000 for our loan amount. And to find our monthly payment, first of all, we're going to type in $200,000. And then we're going to times that by 0.10. So 10% when you're calculating something is 0.10. 12% again would be 0.12. In this case, what we come up with is a number of $20,000. $20,000 is your annual payment. We need to calculate monthly because that's all we're going to be. We may keep it 6 months. So we need to know how much every month is so we know our cost of capital. So we're going to take the $20,000 and we're going to divide it by the 12 months of the year. So in your calculator, you should already have the $20,000, and you're going to divide the $20,000 by 12 months. And here we're going to get our monthly payment. In this case, it's $1,666.67. When you calculate interest like this, it'll probably run out to $666. Lenders, the last penny, they'll either go up or down, and since the 6 is higher than 5, they're going to round up. When we're looking at monthly payments, once again, remember the interest rate is annual. We have to calculate that by the loan amount, not the purchase price. get the annual interest and then divide that by 12. This is your monthly cost for this loan at 10%. So we've gone from point, and now we've calculated monthly payments. So you know the two factors that are going to come in when you're talking to either a private lender, hard money lender, or even a DSCR. DSCR has interest-only factors also, or you can use DSCR as an interest-only. Next, we're going to go over loan to ARV. Loan to ARV. Most lenders are going to give you their maximum loan based on ARV. Remember, ARV, after repair value, is your estimate of what the property will be when it's all fixed up. So you might be buying a flip, putting a bunch of money into it. What does the market estimate based on current sales it'll be worth when it's all done? Or when you go to refinance it because maybe it's a BRRRR, what it's going to be worth or estimated what it's going to be worth. A lot of your lenders out there are going to give you a loan or a loan max based on the ARV. So let's look at an example. Let's say our ARV, when you did your comps, you came up with a value of $400,000. That is your estimated value or your ARV. Now, your lender tells you their maximum loan to ARV is 75%. So this is their max loan that's available through their underwriting based on your ARV. So what is your max loan that you could get from this lender? And that is calculated by taking 75% times 400. That sets up just like this. Remember, a percentage, that's 0.75. If it was 70%, it'd be 0.7 times your loan amount. And this is going to be equal their max loan that they can offer you. It doesn't mean that's what they're going to offer, but this is the max they can. Let's go back to our calculator, put in $400,000, and we're going to times that by 0.75. Always good to run through these, go do the numbers yourself, do these examples so you understand when you're talking to people, you could grab your calculator, run it off, see if the loan amount's going to fit what you need. In this case, the 75% of $400,000, their max loan is $300K. So their loan to ARV was 75%, which means you're going to max out with this lender at a $300,000 loan. We've gone over point. We've gone over how to calculate your monthly interest rate and loan to ARV. Last, let's look at loan to value. And what's the difference between loan to value and loan to ARV? That's what we're going to do next. Okay, loan to value. A lot of lenders, banks, some of the conventional lenders are going to go off of value. They're not going to care about your after repair value. And when they talk about value, they talk about two things. It's either the appraised value or the purchase price if you're purchasing, whichever is lower. And they're going to say, we're going to only lend you a certain amount based on current value. They don't care what it's going to be fixed up. And when I talk about they don't care, it's just certain lenders, like banks, especially traditional banks, but you're going to run across loan to value a lot. Let's look at an example. Let's say you're purchasing a property right now. It appraises, or your purchase price is $300,000. Pick a number, $300,000. And your bank lets you know that their maximum loan is based on 80%. So this is the max that they can loan based on their underwriting is 80%. So they say, we can lend up to 80%. We can lend up to 75%. Whatever it is, we're just going through the numbers here. You could change these out as you go through examples. And I encourage you to do that. Go through some of these examples, do these numbers. So when you're talking to lenders, you could quickly run into your calculator, run through the numbers, and make sure that what they're going to give you is going to work for you. In this case, how do we calculate this again? We're going to times the 80%, which is 0.8, and we're going to times it by 300,000. So grab your calculator. Let's type this in. $300,000 times 0.8. And what we're going to find is the calculator gives us a number of $240,000. This is the max amount that the banks or lender will be able to lend you based on their guidelines. Doesn't mean that's what they're going to lend you, but that's the max they can go to. As an investor, it's always great to understand how to quickly calculate loan to value, how to calculate loan to ARV, what are points, what do they cost you when you're doing the closing, and that monthly interest rate. I hope this helps. If you have any questions or you want us to run through some other numbers, just make a comment on this video or go to our website, hardmoneymike.com, hit the contact us, and we'll get right back to you.